So up now we have our first panel, New Ideas in the Search for Yield, and I'm going to hand you over to our very own George Geddes, who can introduce this fantastic panel.
Thank you very much, Tom. Yes, I'm George Geddes. I'm senior writer here at ETF Stream, and welcome to the first panel discussion of the afternoon. We'll be looking at obviously the new ideas in the search for yield. Looking at year to date, we've seen a large portion of outflows coming from various ETFs, especially as we're looking at a lot of the developed market being in negative yielding. So obviously with me to discuss where the investors are looking for yield, I have Dr. Xiaolin Chen, Head of International at Crane Shares, Jean-Paul Yeagers, Head of Asset Allocation at Barclays Investment Solutions, and John Leiper, CIO at Tavistock Wealth. Just a quick reminder for the audience, please get your questions in and do complete the poll, as we will be touching on that at the end of this discussion. So just to set the scene for everyone here, just to get the perspective of the investors over the last 9 to 12 months, Jean-Paul, could you just touch on how you've kind of handled the bond market in your search for yield?
Yes, of course. Thank you for having me. So, of course, this is not a new phenomenon, but increasingly we see it's pertinent with the low interest rates that in the fixed income world, you're most likely to have a low return if you hold your bonds until maturity. That raises a couple of challenges. So first of all, we see that given where interest rates are, especially outside of the US, that there is very little scope to offset any serious drawdowns you have in equity markets. And that's something we have observed in the recent past in where we had the drawdowns in equity markets. This is limiting the diversification in portfolios. And that's actually in a world where safe havens have become increasingly scarce. We see bonds with negative interest rates, and we see even gold can be your unreliable friend. The second point is the return challenge. And here simply there is no silver bullet. Either you increase on the risk spectrum or you look for alternative risk premium like carry or trend in your multi-asset portfolio. This challenge, we think, is mainly manifest itself differently if you look across different portfolio types. So higher risk tolerant portfolios, it's somewhat easier to find substitutes. So if you want to shift your developed market duration into EM duration, that there is more opportunity there. In particular for low risk tolerant portfolios, this has become increasingly challenging. So there we see that the prospective positive return asset universe is becoming. The question is at what levels do you divest from assets, or perhaps the question should be do not invest at all for those low risk tolerance portfolios, which is quite an extreme option. The last element is we have been looking more into market timing in fixed income. So increasingly we think there is value in timing the market instead of being completely invested. And this is also in the last 12 months where we have been more active in the tactical asset allocation in fixed income.
John, has this been a similar situation for you, or have you got a different perspective?
I think Jean-Paul has described it absolutely spot on. I wouldn't disagree with anything he said. I mean, the huge quantities of debt yielding a negative return is astonishing. And you only need to look at the recent EU coronavirus-related bond issue, where investors placed around 233 billion euros worth for 17 billion euros on offer. And that was because the yield was minus 0.26% instead of, I don't know, 10-year German bond minus 60 basis points. So there's clearly a huge demand out there for yield, and the hard part is trying to find out how to get it. And actually, in many ways, you can move outside the fixed income space. But what I find quite interesting is the change in investor perception towards, instead of generating income from fixed income, how about capital gains? And that's kind of been the prevailing narrative that we've noticed over the last 6 to 12 months, basically, if not more.
I mean, one area that we've been touching on a lot in this event and been writing about over the last couple of months is obviously the Chinese government bond market. Obviously, we have Xiaolin Chen of Crane Shares here, where it is one of your focus. Could you just give a bit of a perspective of why Chinese government bond market is becoming so popular at the moment, Xiaolin?
Absolutely. I think one of the fascinating aspects of working in this financial industry is you constantly get exposures to new investment opportunities. Though China's onshore bond market is the world's second largest in size, and it has a very long history. It wasn't until April last year, 2019, that these Chinese government bonds, CGBs, get included into the broad indices. Obviously, the market estimates this inclusion effort over the the last year and a half from Bloomberg, JP Morgan, FTSE indices recently will result somewhere over $300 billion flow to the Chinese onshore bond market. So you can see the catalyst there of the inclusion effort. And obviously, as China is slightly different, is not pursuing an ultra low interest rate monetary policy. The CGBs actually offer relatively, higher yields when compared to developed market. And most of the Chinese monetary easing has been about putting, large amount of liquidity into the money market rather than targeting a long end yield through yield curve control or, even bond buybacks. So the steepness of the China bond curve, in many ways also offer a safety buffer, which is not so obvious to see in the DM developed market nowadays. So for instance, if you look at the 10-year CGBs, it offers around 140 to 150 basis points yield pickup over the US Treasuries. And it is also true when you consider these returns in the real terms. So for instance, within the region of emerging Asia, China offers the highest, sovereign credit ratings and returns, the highest yields back to the investors. I think the source of, offering these higher yields and, does add the benefits of diversification to clients' portfolio. And additionally, the CGBs also, exhibit a very low correlation with most of the developed, market bonds, as the, Chinese policy making is taking more of like I would say a self style to reflect its own domestic economic needs rather than close adherence to other global central banks. As a result, you see over the past 5 years, the CGBs exhibited a correlation, I think, under 10% to government bonds, for instance, in the US, Japan, Germany, etc. And then particularly, what's interesting to see is during the flight to cash, seen globally in the late February and early March, China government bonds were much more stable than its regional peers. And then with all these interesting, facts to know that still, according to the central bank's data, foreign investors' ownership to the onshore bond market is still only at a little over 2%, it's 2.2% today, but that compares to over 30% of foreign ownership in the United States. Obviously, that's indicate a significant room for the investors to invest in this asset class. And it's the second largest bond market in the world, and that offers tax-free, for instance, opportunity for international investors with this kind of enhanced returns and diversification benefits. In our opinion, it's just too big to ignore in terms of gaining the investment opportunities or insights to China's financial systems for clients' portfolio.
So, John, is that true? Is it too big to ignore? Is the Chinese government bond market something that you've been looking at as well?
Yeah, absolutely. And I did mention that we would probably own the Crane shares ETF if we didn't already own a different ETF from a different issuer. But I mean, we have a policy internally where we look at a range of criteria when we select our ETFs, and Crane shares came out very highly in it. But I mean, bringing it back to the broader point, the integration of China within capital markets is probably going to be one of the biggest shifts in my lifetime. And it probably already is. And it's a large market, it's underinvested from a global perspective. It offers very attractive real and nominal rates. And any investors who haven't yet invested in the space, it's likely only a matter of time until they do so. We believe investors are well compensated given China's relatively low debt to GDP ratio, particularly relative to several heavily indebted European countries, and a pretty solid credit rating as well, thanks to its steadily managed foreign reserves. So, Chinese government bonds proved remarkably resilient during the early part of the turmoil. During this period, obviously they came off a little bit, but we now think they offer a very attractive entry point, which in terms of where yields are now, and in terms of the Chinese credit impulse that we think is going to flow through over a period of time. I think the only potential risks to the position that we might want to think about is if you cast your mind back there was a period where, from a political perspective, there was a bit of pressure on some US companies perhaps divesting from investments in certain Chinese companies, where if that proved controversial at the time, think about the prospect of you investors investing directly in the Chinese state. So depending on the outcome of the election, which is still very volatile as we speak, we don't necessarily know how it's going to turn out, but that's probably the risk here. But I would say that risk is dwarfed by the long-term structural tailwinds behind this space.
Just to move away then from the China market at the moment then, John, is there any other areas that have been of significant interest, such as subordinated debt or fallen angels?
Yeah, I think the areas that we've been focusing on generally from a fixed income perspective are, over the long term, as Jean-Paul mentioned, government bonds, their diversification benefits can be called into question, and you may well be locking in huge negative real yields over the longer term. But within that space, we have a relative preference for European government bonds, which have massively outperformed US government bonds since around July, for a number of reasons. There's been this, since the Fed came out and effectively backstopped investment grade credit by saying that they were going to go out into the market and actively buy ETFs for the first time, and I think they used iShares to do that. So LQDA, their ETF for US investment grade credit, has done quite well. And that backstopping of credit by the Fed has effectively opened up the door to say, well, we're going to draw a bottom line on this, but you can get a pickup in yield relative to what you would get maybe elsewhere. So that's been a relative area of interest. But I would say over and above Chinese government bonds and perhaps even emerging market debt more generally, inflation has been one of the key themes we've been looking at, because the coronavirus is going to impact production costs due to the COVID crisis, which is already exacerbating what we consider to be a deglobalization trend that's been in place anyway for some time. Monetary policy, very, very loose. We don't think it's going to go away anytime soon. And the Fed is also explicitly now implementing average inflation targeting. So it's going to take a lot for them to get to a point where they want to choke it off, which is the policy that they followed previously. But on top of that, you now have this kind of perfect storm where you potentially have the combination of monetary policy and fiscal stimulus. Now, maybe that fiscal stimulus might not be quite as large as we thought it might have been running into the election, with polls pointing towards more of a blue wave. But we think it's still coming anyway. It might just be a different order of magnitude. Those things combined mean that we are likely to see a real pickup in inflation moving into 2021 and beyond. And financial conditions are an excellent leading indicator for inflation and inflation expectations. And on our model, with a bit of a time lag, we see inflation expectations really picking up into 2021. So that's something that's worked really well for us kind of up until around September, where I think the foot came off the accelerator a bit. Maybe now's a good entry point perhaps to get back into that trade. And then just very briefly, we're not invested in subordinated debt. There are a whole range of risks with it. But if we are going to bring the conversation back around to the question of yield, you either extend duration or you move down the capital structure. And subordinated debt is an area that might be interesting to certain people with the correct risk tolerance to do so. For us, we're not quite there at this stage. And then also high yield bonds is also not an obvious place to generate a slightly better yield as well. But once again, we think the liquidity crisis has been solved, but we're skeptical that we're through it from a solvency perspective. So we're positioned in fallen angels, which is the higher quality tier within high yield. And actually, because of the lower exposure to energy, that's the part of the high yield space that has done particularly well over the last 6 to 12 months or so.
Jean-Paul, what sort of strategy have you taken for your fixed income allocation?
So in the multi-asset portfolios this year, we have been relatively active. So we started the year with quite some underweights in high yield and investment grade. We felt those were quite expensive. And in client portfolios, we were quite low on duration. Then we did see that the pandemic accelerated, and essentially this was an event that, irrespective your investor career, very few people would have really had a sense on the exact repercussions on how we would get through this. Then in February and March, we have been increasing equity holdings quite sizably. A lot was discounted, we felt, after the drawdowns in excess of 30%. Little bit later, we have been buying quite a bit in high yield and investment grade. That's where we saw the policy response kick in, and we felt, well, in that kind of environment, you will be rewarded in credit as well. Over the summer, we have been taking down equities and investment grade to benchmark weights, so closer to what we normally would hold in client portfolios, and we've been expanding on the emerging market dollar debt side. If we look within credit, we feel this is some of the areas where you get compensated within credit. If we now look to client portfolios, we still lean into US high yield, we still lean into emerging market dollar debt, we're broadly flat on equity risk. So that's if you look at it from a portfolio positioning point of view, more in the near term. But if you think about it more strategically, then it's quite an interesting times. We see quite a number of extremes. We see monetary policy, we see increasing debt, we see monopsony, so that's the employers dominating the labor supply, capital to income ratios. So does this create the potential for regime changes more strategically? Does it possibly is the case that the next 10 years look quite differently than the past 10 years? Question mark. I don't know the answer, but that's something we're definitely pondering over. Yeah.
That's great. Going to you now, Xiaolian. Obviously, the central bank plays a key role within this sort of market here. Could you just give a bit of background as to what their role is, the central bank within the bond market, and how it kind of differs across the globe? Any key highlights you can pick out?
Absolutely. I think here, well, the balance sheets of the Federal Reserve and of European central banks is piling up. It's a polite word, is exploding. The Bank of China, PBOC's balance sheets has remained fairly steady in many ways. Market expects November's meeting is happening today and tomorrow would hold, the federal funds targets range unchanged, probably around the same rates. The combined purchase pace that we have seen in the last couple of months through in the summer of $120 billion of purchase per month is likely to be kept in place at least throughout the end of the year, in our opinion. I think, it's also interesting to see the first euro of the 17 billion of the euro, the Sure bond, to support the mitigate the unemployment risks, attract, orders more than double the entire program. And then I think that's also interesting to see that who owns those kind of bonds. And then as the market was saying, as the largest ever social bonds, that most are, ended up in the hands of ESG investors, which is also very interesting to see a area of developments. I think, this bodes well for a much larger of the potential of the next generation, the union funds that are projecting $750 billion of issuance. So, all these combinations is encouraging to see the issuance is in place in the market, though, there's also a paradox of saying the Japanification of Eurozone, where the economic backdrop suggests the interest rate will be no higher than zero for a very long time. And indeed, reflecting this, I think the yield curve will, for swaps is in the negative territory all the way up of the curve. So I think the new issued bonds potentially will reflect this as well. So obviously, we're here to discuss the panel for searching for yield, obviously searching for a positive yield within Europe continue to be challenging. And for instance, taking the 5-year maturity points for the biggest issuer, the current range is set by Germany of negative 80 basis points to Italy at 13 basis point positive. But if you look at the similar duration in the Asia land, I'll just use China as another example of the 5-year CGBs is sitting at positive of 230 basis points. So that's just huge contrast and differences of, as a result of the different stance in the central bank policy. As a result, you see the yield in different countries and regions are sit very differently. Obviously, we believe the investors, either benchmark aware or agnostic, would have to be more open-minded in accepting the new ideas for yield picking up and clearly to expand the asset classes from bonds they've known and invested for very long in the Euroland and probably to other regions and countries that is in the trend from now.
Obviously, one country that's been a key player and a big highlight this last year is the US, especially with the presidential election, which we've already touched on. Just going to you, John, how has the US market been? Obviously, it's been a focus of yours. Just a bit of detail of how the US has been playing, how it's been impacting your fixed income allocations. Also, the Federal Reserve, what they've been doing that's been of interest.
Yeah, I mean, I think in the US, well, the global coordinated policy response to COVID has been incredibly impressive, and it's been immense in magnitude and very preemptive, i.e., let's just pull out the 2008-2009 roadmap and not wait a few months before and let markets tank. So it's been absolutely fantastic, and that's why asset prices are kind of back towards where they were at the end of 2019. The issue is, as time has gone on, the focus has been less on monetary policy and increasingly in the US on some kind of fiscal policy. And you can see markets gyrating with as the negotiations are going on with Pelosi and Mnuchin and as it were. So that's kind of interesting given where we are now, which looks increasingly like we're not going to get a blue wave, which many people felt was priced into markets to some degree, perhaps at least until the last few days before the election. And when I say not a blue wave, what I really mean is in the economic sense, that there may well not be the big game-changing shift towards fiscal policy that we thought might well have been the case previously. And the reason why is because no matter who wins the election, and who knows who that's going to be, it looks like the Republicans are going to continue to hold on to the Senate, and that's kind of the key story. So now maybe the narrative is shifting from relying more on fiscal policy to, is it going to be the status quo? Are we going to have a bit more of the same, i.e., lower for longer interest rates? And that kind of brings us towards a nice narrative in terms of Jerome Powell at the Fed, because with average inflation targeting and everything that they've announced over the last few months, it seems to be moving from lower for longer, because they don't necessarily want to go into negative interest rate policy, to further for longer, i.e., further stimulus from a Fed perspective. And I think that is probably more positive for fixed income markets than might otherwise have been the case had we had that blue wave sweep. In terms of how we're positioned, it's kind of interesting today, really, because we've been positioned for some time for a steeper yield curve in the US, and the yield curve has been steepening for some time. So we've really benefited from that. But the gyrations and the volatility we've seen on the 10-year Treasury yield in the last few hours has been remarkable. It's popped up to 0.94 and it's come all the way back down to 0.78. Let's just strip away the politics and let's just focus on the fundamentals. We think those key drivers for a continued steepening of the yield curve are going to remain in place for some time, both on the demand side as the recovery hopefully continues to pick in, but also on the supply side. Now, importantly, I think the Fed isn't going to let things run away from themselves. They need to keep financial conditions loose to keep the show on the road. So they're going to be concerned about yields rising too much at the long end of the curve. Of course they are. And yields are anchored at the short end of the curve. So will they step in and will they conduct some kind of operation twist and really start to focus more of their asset purchases on longer dated bonds? Possibly. But we think that unlike 2011, 2012, where Operation Twist did lead to a flattening of the curve, the supply-demand dynamics and the expectations for continued growth and the pickup that we're likely to see into 2021 will continue to translate into a steeper yield curve. So, that's how we're going to continue to be positioned for the time being. Maybe today's a better entry point for that same theme. I don't know.
Jean-Paul, could you explain the situation in Europe? Is there anything more the central banks here could be doing?
Well, it was 2017, I think, when Mark Carney said the 15 minutes of fame for central banking are coming to an end. And here we are in 2020. So central banks are incredibly inventive, and we have seen that in the recent decades. So if you look to the evolution of monetary policy, how that has been evolving, it's incredible how central banks have been adapting through time. Although fiscal responses has done more of the heavy lifting recently, and in that sense, I think can be more targeted, which may be more appropriate in a response to a pandemic. But arguably, in terms of conventional monetary policy, as John just alluded to, there is less room for policy rates to sink much further. But still, in theory, central banks can still do more. There's yield curve control, They could go technically into deep negative interest rates. In one of the previous presentations, there was discussion on helicopter money, monetary MMT. So there are still ways they can do more, but I think that the hurdle is relatively high at the moment. And those options come with challenges and risks as well. We have seen, as John also alluded to, that the US Fed has been adapting policy framework to average inflation targeting instead of looking at year-over-year inflation numbers. This is creating the potential for them to allow or to tolerate a little bit of an overshoot on inflation for some time if needed. But I think what's also interesting to note is that in all kind of the policy responses, in particular in Europe, we have seen it's increasingly ESG tinted. A lot of the responses have resulted in issuance of green bonds, in particular in Europe. So that's, I think, one of the positive spins on all the policy responses we've seen.
Just to go back then to China's inclusion within looking at China government bonds, obviously its inclusion within the likes of the Bloomberg's global index, flagship index. We're also seeing FTSE Russell has announced that it will be starting to include Chinese bonds in its world index as well. Xiaolin, could you say how big of a step this is for not only just the Chinese market, but looking at the bigger picture of are index providers having to start looking at what are the best opportunities for investors?
Absolutely. I think the inclusion steps have been announced or actioned by different index provider is absolutely critical and absolutely important. I think investors now sit outside of China. Now you would have to look at the asset classes and learn these new investment opportunities in many ways, right? I remember back to my old days of being a portfolio manager myself, that managing a collective wealth of $70 billion. When I met with John Crane, our CEO at Crane Shares, he literally asked me a question: how much allocation do I have in China? Literally in equity and fixed income, this is over 5 years ago, it's really nothing. The equity inclusion happened about 2 years ago. Fixed income inclusion happened really April last year. And it's very good development announced by FTSE literally last month of including the govies and potentially the policy banks that you can get included into indices, et cetera, et cetera. I think the investors now have a broadened toolkit to look at in fixed income asset classes as where to allocate, how they to allocate. I think just look at from a China onshore perspective. I think this inclusion effort into the global indices for international investors to be able to benchmark and use it as deciding their asset allocations will definitely encourage and escalate the onshore capital market reforms in many ways you would expect. And I think if you remember, since the Bond Connect introduced in 2017, that has remarkably increased the accessibilities for investors outside of China to access the onshore bond market, and simultaneously you also see the issuance of the CGBs has increased by over 8 times in just 2 years' time. It is also very encouraging to see now the foreign investors literally bought over 1/3 of the next supply of the Chinese government bonds in 2019. I think many developments will continue to improve because of the inclusion effort announced. I think, for instance, allowing an independent rating agency to participate in assessing the onshore bond will increase investors' confidence in investing in these bonds. Like you and I sit outside of China, wants to have a work and knows the same framework that we always use to understand to assess these new asset classes get included into the indices for us to increase our confidence saying I have wanted to look at this asset class, understand what am I investing into, and obviously from getting very comfortable with the asset classes to having an easy access to the market, and also get almost a check or stamp by the rating agency in assessing the associated risk. That entire complete process will definitely also work the other way around to give the index providers more confident to say, we probably look to increase the weights of the China's allocation in our broad indices to reflect. I think this has got a significant room to go if you think about it. At the moment, Bloomberg has somewhere around 5-6% into their indices, and so is JP Morgan 10%, and FTSE say 5 or a little bit more. But again, this is the second largest bond market. If you think about it, the VIX will eventually reflect China's economic importance in this financial market as well. So we do expect, continued efforts to be here, continue, kind of like improvements from the onshore market in multiple ends, and then give confidence to the investor back to invest in this asset class.
Very good. Just before we move on to some questions we got from the public, I'll just quickly touch on the poll results that we had going over this panel. Obviously, we asked if the audience believed China should be classed as a separate segment within the fixed income bucket of emerging markets, and unsurprisingly, it was 100% yes. Is this much of a surprise to you, Xiaolin?
I think it's very interesting to see. I think, Josh, a few years ago, CoinShares is only 8 years history of firm, but when we started our business, when we talk to people about China, they would say, "What?" What are you're talking about? And then from that day, I think this is interesting background. When John convinced me to leave JP Morgan to join CoinShares, he says, "Do you believe China will be an asset class on its own one day?" Back then it was 2013, 14, inclusion wasn't even happening, and I kind of like, yeah, we're going to try it out. And then MSCI proved us correct. The fixed income markets indices provider proved us to be correct. It's very encouraging to see the investors are very well educated nowadays for China's financial market, asset classes, etc., etc. I am personally very encouraging to see that everyone thinks fixed income deserve a place in their portfolio as a standalone, and we do believe that should be the case as the weights increase, and investors should have a separate bucket for China fixed income market holistically, not just the government bonds, obviously the corporates. I think John and Jean-Paul mentioned in their speak as well. That's the available of the asset classes would be expanded.
Very good. Just looking at some of the questions we got from the audience here. Surprisingly, we haven't touched on it so far this afternoon, I believe, but ESG. One question is, does fixed income ESG ETFs provide more challenges compared to the equity counterparts? Not sure if they mean from the investor's perspective or the issuer perspective, but going to you, Jean-Paul, do you have, when looking at ESG within fixed income, do you take a different strategy if you do look to allocate it to your portfolios?
So I'm disqualified. I'm not the ESG and the ETF specialist on our floor, but what I do notice is that within multi-asset, there is an increasing demand for having income type of impact funds or ESG funds. And I do have the impression within equities, it's much more established on what exactly to do with that. We're still within asset allocation, within macro, it's not that easy. So I think there would be a natural demand for fixed income that's ESG tinted. Yes.
What about you, John? Is that a similar story?
Yeah, from a product development, our experience is there's a lot more ETFs out there that are in the ESG space than there are in fixed income. Over the last year or so, we've seen some green bond ETFs coming to market, and actually we've been proactively rotating some of our corporate bond exposure into indices that also conduct various screens. And one of our key themes is to invest in those parts of the market that may well benefit from central bank bond purchases. So, for instance, there's a growing expectation as we approach December that the ECB may look to conduct something similar to the Fed in terms of buying corporate bonds, but very much with that ESG tint to it. And there are various indices that can give you that exposure that we currently have in the portfolios.
Perfect. Very good. Well, that looks like we have just come to the end of our discussion now. I just want to thank all of the panelists for joining us and having a very interesting discussion there. And thank you for the audience for tuning in for that one. I think we're just going to bring Tom in now. He's going to be giving a few details before we head to our networking break.
Yeah, thanks, George. That great stuff, guys. That was really interesting. Yeah, we've got about 15 minutes for a networking. I do encourage everyone to visit the expo area where all the sponsors are. They're all doing some really interesting stuff. So do head over there, have a chat with some of other attendees, and do check out the ETF Stream booth as well. We're doing some interesting stuff. Even if I say so myself, we've got Beyond Beta, got a couple of events coming up towards the end of the year, a few webinars as well. So do go and have a look. But otherwise, see you in 15 minutes for our panel on ETF liquidity. Thanks.